Every breakout on every chart asks one question. Does the move hold or does it fail? On the left, it fails. Price pokes above, finds no buyers and falls back inside. You fade that. On the right, it holds. Price breaks out, pulls back, and keeps going. You wait for that pullback, then you follow. Get this one call right, and you stop chasing fakeouts and you stop fading real trends. Here is one full trading day. Now, the one thing you actually knew in real time was the first hour of trading. Market's high and it's low. That box is the initial balance, and it is fixed the moment the first hour closes. These are the levels you trade. So when a day opens quiet and rotates inside that range, here is the plan. You place a resting sell limit right at the initial balance high with a stop just above it. You are not predicting anything. You are letting price come to your level. Watch. Price rallies back up to the high, and your resting limit fills you short. From here, it plays out on its own. If price rejects the high, you ride it down toward the initial balance midpoint, which is your target. If instead it breaks out and closes above, your stop takes you out for a small loss. Here, it rejects and rolls back down to the midpoint. Target reached. Now, separately, we can build a volume profile. We estimate how the day's volume was spread across price using 15-minute bars. By the close, the busiest price, the point of control, formed near the initial balance midpoint. But notice the order. That profile is end-of-day context. It is retrospective confirmation, not information you had at entry. And look at the risk on that trade. Your stop sat just above the high, only a small distance away. Your target, the midpoint, was the whole range below it. Small risk, bigger reward. That is the appeal of fading a quiet, contained range. But not every move fails. Some breakouts are the real thing. So here is a different day. We start exactly the same way, marking the high and the low of the first hour, the initial balance, known right after the open. On the range day, price stayed trapped inside this box. This time, price pushes up and closes above the top of the range on one big candle, and then it holds. It does not close back inside the range, and when it pulls back, it respects that old high. That is what holding means. 3 things. A close above the high, no close back inside, and a pullback that holds the level. This is a trend day, not a range day, so you do the opposite of the range day. You do not fade the breakout, you trade with it. But how you get in is everything. So price broke out on one big candle and closed above the range. That close above is your signal it accepted the breakout. Now here is the plan, and it is not chasing. You place a resting buy limit back down at that high, and you let price come to you. Why there? Because the old top, the level that capped every rally on the way up, now flips and becomes support. The old ceiling is the new floor. So price pulls back, taps that level, and your resting limit fills you long. Your stop goes just below the low of the breakout candle, the base the whole move launched from. From here it is out of your hands. If the level holds, price runs. If it breaks the base, you are out small. And here is how you set the target. Take the height of the first hour range and measure that same distance upward from the breakout. That is the measured move, and that is the target. And it runs. From your fill, price lifts off, makes a higher high, and climbs to the measured move target. The breakout got you interested. The resting limit got you in. And here is why that beats chasing. Your stop sits just below the breakout base, close to your fill, so your risk stays small. Chase the breakout candle instead, and that same stop is far away, for the very same target. The limit is not just a better price. It is a better trade. Now here is the failed fade on this same day. Remember the rule. You only fade when the day stays quiet inside its range. But here, the breakout closed above the high and held. That is a trend, not a range. Someone fades it anyway. They short the high, betting on a reversal the day has not earned. Price does not reject. It runs higher and higher straight through the stop just above. The fade is invalidated, and the stop is triggered. The loss is small and controlled. because the stop was defined in advance on the very same move the patient buyer wrote up. Same level, two opposite plays, and the difference was one call. Fade only what stays inside. Follow what breaks and holds. Here is a second example of the same setup logic on a different stock. The first hour sets the range. Price breaks above the top of it on a strong candle and closes above. Same plan. You place a resting buy limit back at that high. No chasing. Price pulls back, taps the level, and fills you. The old ceiling becomes the new floor, just like before. Your stop goes just below the breakout candle's low, and the target is the same measured move, the first hour range measured upward from the breakout. From your fill, price runs to the target. Now, two winners show you the setup. They do not prove an edge. A real test needs a much larger sample to measure the win rate, the average reward, and the risk. This is a clean example of the rules, nothing more. So the whole skill comes down to one question. When price tries to leave its range, does the move hold or does it fail? On the left, a range day. The move fails. Price pokes the edge, finds nothing, and gets pulled back inside. The signal, a rejection at the edge and a return inside. When you see that, you fade the edge. On the right, a trend day. The move holds. Price closes above the high, stays above, and the pullback respects it. The signal, acceptance above the high and a supported pullback. When you see that, you do not fade. You trade with the trend and you enter on the pullback. Same question, two answers. The move fails, you fade. The move holds, you follow. Let us lock it in. First, after the first hour, mark the initial balance, the high and the low you now know. Then watch the edge. A rejection at the edge, with price falling back inside, can set up a fade back toward the middle. Acceptance above the high with a supported pullback can set up a long entered on that pullback with the measured move as the target. And the volume profile. Use it as end-of-day context to see where value built unless you are reading a developing or prior session profile in real time. Initial balance for the trade. Profile for the context. See a chart this way, and it stops looking random. 2 days, one question. A move that stays inside gets faded, back toward the middle. A move that breaks and holds gets bought on the pullback. The initial balance hands you the levels. The question tells you which plan to run. You have a clear framework with a resting order and a defined stop ready for either outcome. So, mark the initial balance, ask the one question, and follow your plan. If this breakdown helped you, do me a favor and subscribe to NYTradeStudio. I will see you in the next one.